Was good, y'all? This is Joel, and I'm coming at y'all with another video. So, I told you guys the past few videos that I was gonna do. It's like daily review, daily recaps of NAS. And I did a few for the week prior, for the week of July 3rd to July 7th. Um, I dropped 3 videos for recap of July 3rd, which was a trading day, a winning trade. July 4th, which was the bank holiday, which I wouldn't trade on, and July 7th, which is NFP. Now today I'm doing a review on Monday, July 10th, which would be a trading day, right? Based on the economic calendar. This calendar is like my Bible when it comes to trading because this calendar tells me the days that I'm going to be trading versus the days that I won't be behind the charts, right? So we do not have any news on the 10th or the 11th. So these 2 days I would actually be behind the charts, actively looking to trade, while the 12th and the 13th, these are the core CPI and core PPI events, which I would not be trading on. And July 4th, just a standard news event, so I would be behind the charts. So for this week, it'll be Monday, Tuesday, and Friday. But I do believe I'm going to do breakdown videos for each of the days, just so I can explain more about core CPI and core PPI. Um, and so I can, go more in depth as far as why I don't trade these days. Just for the quick spark notes, for core CPI, usually on these news events, price skyrockets in one direction. So either it will typically either go straight up or straight down. And for core PPI, this news event, usually once it hits the 8:30 mark, usually it will be a massive like a candle that will wick both sides. Um, Essentially taking out the liquidity both buy side and sell side, right? Traders on both sides. So as far as like a core CPI event, it's not ideal for my strategy just because the way I operate is I wait for price to attack one liquidity pool before breaking structure and attacking the other side, right? Core PPI usually just goes in one direction, so it's not ideal for my strategy. And core PPI, all the liquidity pretty much gets taken in like a minute, so it really wouldn't make sense for me to be behind the charts actively looking to trade if I'm already expecting there to not be trades on those days. So jumping right in, for this day, this is the Monday, July 10th trading day, and at the start of my strategy, I wait for the 8:30 mark. So right here, we have our time set to New York session. If you click the time below, right, UTC-4 New York. This candle here, this 8:15 candle, is a candle from 8:15 to 8:30. So once we have our 8:30 candle formed, what I like to do is I like to mark the liquidity pools at the 8:30. So where is the most obvious swing highs and swing lows? So if we look left from this area, the most obvious swing high, right, is this level right here. So if we look at, um, so if I hover my, let me just move this a little bit. So you guys see the highs and lows, the values at the top left, where it shows the H, this is the high, and the L is the low. So if I hover my mouse over this candle right here, the 8 o'clock to 8:15 candle, you see the high is 150.62.4, while the high of this candle is 150.62.8. So this candle is technically higher than that candle, which would make it the most obvious um, swing high, right? That would have the liquidity. Since this candle never went above this candle, there's still orders that are saved above this candle. There's buy side liquidity, right? Since the candle to the left and the candle to the right are both shorter, right? There will be orders just sitting above this, resting above this candle. Now the same idea for the sell side liquidity, right? We want to find the most obvious swing position from the 8:30. So we keep going down, right? We're not seeing anything until we get to this point right here, this candle, which is on an island by itself, right? We highlight that, and that is our sell side liquidity, right? So once we have this, we can basically jump down into the 1 minute chart. And as a reminder, right, the 8:30 mark, which would be this my line right here, the next candle. This is where we can expect the hunt to begin, where the market will begin looking for liquidity to attack it, right? And so we mark the obvious buy side and sell side liquidity at the top and the bottom, and I've color coded it for you guys. So if if price attacks one of the liquidity pools between 8:30 and 9:30, that's fine. We just want to see at the 9:30 open a deeper push into that liquidity pool before breaking structure, right? We want to still see 9:30 um, either deliver the peak, the highest point, or the lowest point in the move, like in the total sort of area of price action in this session, right? Before delivering a break of structure and taking it lower. And then if price delivers a fair value gap or an imbalance, we'll take that down. So I'll do is I'll keep fast forwarding it, right? So um, I'll mark this for you guys. I mean, it's not really necessary, but I'll just mark it. So here's 8:30, so you guys know, right? And I'll continue. I'll actually mark 9:30 just so you have that as well. I'm just doing this to sort of help the people who are still learning, who are newer to this, right? So price is pushing down, right? It really doesn't matter. This is all this whole area. We just want to see price take one side before going down and taking the other. Like if price just move left and right, like consolidating within this range, we literally just sit on our hands. Like we just don't do anything, right? There's no trade for us to take. So keep watching price. Iron price is now moving a little higher, now lower. Oh, right. So now you guys see nothing really happened, but then the 9:30 open, this candle right here, this massive candle came up and spiked into buy side liquidity. So immediately, once I see that buy side liquidity was attacked, my first thought process is one, I put my eyeball icon, which reminds me that the liquidity is taken, right? And the next thing that comes to mind is that I'm already thinking sell. Like I'm only looking for sell opportunities. I am not thinking about buying price whatsoever. So the fact that price pushed up here, it gave me its bias. It gave me the bias that it wants to be bearish. That it pushed up here to activate orders so that hopefully it can break structure and then go down to attack the other liquidity pool. So that's what's going through my mind right now. So now price went into the buy side liquidity. So now I also want to mark the last um, point of structure, which is level right here, right? This is the last swing low, right? You're seeing here, it's a swing low before the liquidity grab. So if price comes above and clears a new level, if it makes a new high, then if it delivers another swing point, we'll move the light bulb up. But until then, right, we have to keep it there. So now we're just watching price to see will price either break this level or will price break this level, right? So nothing's really happening. Okay, boom. So this massive candle down here, right? We zoom in. This low, even with the wick, broke this level. So now price is bearish. I consider this a structure break. And now, was there displacement and a fair value gap? Yes, right? We're seeing these aggressive candles. Like this candle in particular is super aggressive the way it basically flew down here. So we'll also fast forward one more candle, right? So now we're seeing two large fair value gaps, right? We're seeing one, oops, we're seeing a gap here, and we're seeing a gap here. So now with my strategy, fair value gaps were left, which is great. Now another important key factor is that the fair value gaps need to be within the displacement range. With the displacement range is this level that I'm going to shade in pink. So this is the displacement low and displacement high. So these are the lows and the highs, like the range before the break-in structure. So this was the official break-in structure. So now we need to see fair value gaps fall within the pink range. And obviously, as I shaded here in the 1 minute time frame, you're seeing these gray boxes. These are the fair value gaps that were left. So me as a trader, I normally like to trade the more extreme fair value gap, right? So this gap that's all the way up here would be my preferred entry. Um, could you enter at this level? Yes, technically yes, because it's also a fair value gap. But I like to see price deliver a deeper retracement, so it can give me a better entry, better stop loss, better risk reward, everything. Now it could potentially lead to me missing out on a trade, but I'm perfectly fine with that because when I want my trades to have good risk reward, and when I win, I want to be able to win a sizable amount, not really risk like a one to one. My bare minimum is a one to two, but realistically, I would prefer like one to three, one to four, things like that, which is very achievable with a pair like NAS. Um, so right, I mark my fair value gaps. Either in the 3 minute, 2 minute, or 1 minute. Um, so in this case, I mean, I usually like to prefer to stick on the 1 minute if I have the opportunity to. In this case, I have a gap. So this essentially would be where I would set my limit order because I like to trade with limit orders, just so I can have you know further precision and just kind of like trade lazy. So it's like if the market, when the market trips me in, then I would be in the position like I wouldn't have to like actively push the button. It's like for me, it's like I like to plan my trades out. So the second I would see this break of structure and I see the gap that was left, I would immediately, have this set up. Like I would put my sell limit order right here. I'll put my stop loss above this high. My take profit all the way down here, and I would just, have the limit order set and ready. And it'll be active until 11 o'clock since my trading hours is from 9:30 to 11. After 11, if I'm not in a trade or nothing happens, then I just delete the limit order or I just continue with my day. I don't take trades after 11 a.m. So see price broke down. So now we essentially wait for something to happen. If let's just say for example you wanted to take price from this fair value gap, right? It would only be like a little bit over a one to one, right? So it wouldn't, in my opinion, it wouldn't really be worth it to take the trade. I would take the trade from here. So as we keep pressing fast forward, right, you see price came up here and actually tapped into the gap, right? Price came up, tapped into the fair value gap. So if you sold here, this would have been a valid sell entry, and then price continues going down, and then boom, it takes the liquidity. So yes, I do remember um, being behind the computer for this session here, and obviously based on what I just showed you, right, my limit order wasn't activated. I wasn't tripped in the trade, right, because price never gave a deep retracement. It sort of just retraced a little bit into the fair value gap and then melted. So once price slashed through this liquidity, I immediately deleted my limit order because both liquidity pools were taken, so there's nothing for me to trade. So on this day, it wasn't a trading day for well, on this day, I didn't take a trade, right? Because it was never activated. But I'm sure there were other people who took a trade, and if they did take a trade, of course, price ended up going down and hitting take profit. So if you did take a trade at this large fair value gap, right, that would have been, you know, about a one to one. So you still would have walked away with profit, right, on a winning trade. Same idea here. If I go on the 2 minute time frame, right, and I mark the fair value gap, this would be the gap on the 2 minute. uh, you would have to have entered on a market execution because if you did a sell limit order, it probably wouldn't have activated given how, with spread, probably wouldn't have activated. And now in the 3 minute time frame, nothing ever activated on the 3 minutes, right? So this was a trade that was only really possible to take, I guess, on the 1 minute or 2 minute time frames. But that's pretty much um, this whole breakdown for this day. So if you entered at this fair value gap, right, you would have entered 9:45 and then been done with your day literally 6 minutes later at 9:51, right? You would have been out of the trade. So it's pretty much a simple breakdown of Monday the 10th. Now, with me taking this trade, I do remember putting on half uh, of my position, like risking half of what I normally risk, just because when I see price gets taken, I like to see an immediate like aggressive move down. Like this move that we're seeing here with the black candle, black candle, black candle, and like prices melting. I want to see that pretty much immediately after a liquidity grab, or like if a high gets cleared, I want to see it happen right after. I don't want to see like a push up and then a little move down and then a small little retracement and then a push down, right? Like I would want it to be just aggressive like right away. So this, my opinion, I wouldn't consider this an A plus setup. I'll probably put it like a, I don't know, like a B, B plus maybe, just because it was like a little retracement. Like I want to see when we see a break of structure, we want to see like an actual shift of momentum. We want to see like aggressive movement. We don't want to see like buy side orders get activated and then price sort of like hovers around the area. You know, even though it did deliver the fair value gaps and it would have been a winning trade, and if price retraced higher up here, I would have been, tripped into the trade, and then it probably would have, hit the take profit. But this isn't like, I wouldn't consider this really like an A plus setup, but it did deliver a winning trade. So um, once again, if I would have been activated in this trade, I would have taken half risk, but it didn't trip me in, so it is what it is. But this pretty much is the trading day for Monday, July 10th. So if you found this helpful, do leave a like, subscribe, um, turn on post notifications because I will be dropping a lot of content moving forward. I want to keep doing these daily recap videos just because I'm behind the charts almost every day, right? Depending on what days I'm able to trade on the marketplace. But I want to, help young aspiring traders sort of figure out this journey because I know trading can be uh, quite the quite the obstacle to tackle, right? Like this is literally like learning a new language. So I'm sure uh, people who stumble across the video, watch the video, really absorb the content, can begin seeing the market for what it is, right? That the market is really just trying to play both sides. It's generating orders to play both sides and then, take out traders on both ends, right? You're seeing here price came up, took out buy side liquidities, activated the orders up here, took out buy side liquidity, and then shortly after prices broke down and took out sell side. So this is literally what NAS does every single day. Um, and this is applicable to both people trading with forex brokers or people trading stocks. So I do appreciate if you stop by, watch this video. More content coming soon on the way. So yeah, thank you so much if you made it this far. Once again, this is Joel, and I'm out. Peace.